If you won the lottery, would you share any of those winnings with your family? Yeah, that's what we're going to talk about with Dion Beg and more. You see, my friends, if we've been in real estate for at least 10 years, this question is important to you. All right, my friends, as promised, here's my good friend Dion Beg. And Dion, what is going on in your world?
All right, Gary. So yeah, there's a lot going on, but one topic that's sort of top of mind and is happening in conversations with myself and my team is this issue of affordability and how first-time home buyers can break into the market today. It seems like it's the same question that you and I have been talking about for probably the last 15 years, but it evolves as the economy evolves, as stress tests evolve. So we're facing slightly different challenges today than we were facing, say, 5 years ago.
And I feel too the affordability conversation, it just it's like fuel to the fire. It's highlighted even with, especially with social media just being in our hands all day, right? And everyone talking about it. And I know if you go on any Twitter feeds or anything like that, at least mine, because mine, obviously mine's real estate and mountain biking and soccer. So that's my Twitter feed. However, the real estate side is the affordability piece. There's a lot of people that are concerned about it, and talk to us a little bit about some of those concerns you're seeing from the financing side.
Sure, sure. So if I go back in time, and if we go back, say, 5, 6 years, or not even that long, just 2 years ago, um, or sorry, let me go back. Sorry, 5 years ago, the government introduced a stress test. Now, what does that mean? The importance of that is that if your contract rate on your mortgage was 3%, they would test you at a higher rate of around 5%. So prior to that, if it was 3%, you got tested at 3%, and usually you were able to borrow something like 6 times your income. Okay. When the stress test came in and they were testing you at a higher number, it was something like closer to 5 times your income. Right. Now, as rates have increased and the stress test has floated up together with rates, now we're testing some clients at 8 or 9% stress tests where we used to be closer to 5. And you can only imagine what that does for affordability or your ability to borrow. It's now diminished to where it might be something closer to 4 and a half times your income. Also, if you're buying a place with a condo fee, that also detracts from that number, so it could even be lower. So number one, people are able to borrow less based on their income. That's one problem. The other problem is we've seen this meteoric rise of pricing at the same time. Yes, it's come back significantly from its peaks of last year, but it's nowhere near the number that was in, say, 2018, 2019. So we've got this higher stress test, higher price, which sort of forms this bigger issue today for first-time buyers than it was before. In terms of solutions, though, let me go to that slide that we were talking about off screen, and maybe we can get into that conversation there.
I like
So
it.
this presentation today, or this conversation, is around first-time home buyers, but more so now than ever. Almost every deal that we're getting where we're helping a first-time home buyer does involve family. And it's because of that affordability factor, because of the fact that we can only borrow 4 and a half times income for a first time buyer. It means that people are needing to turn to family. So, what I want to talk about here is this question. This question is to your viewers or listeners who are probably aged 40 or 50, 40 years plus. Okay. The question is this: if you won the lottery, would you share some of your winnings with your family? Let me ask you the question, Gary. Would you? Are you that generous kind of guy?
I'm going to say yes because they're watching.
Of course.
But of
Yeah, they're
course,
going to hold
yes.
you to it. They're going to
That's
hold you
it.
to it because it's recorded now.
Yeah.
All right. So then, if you feel that way, well, if you have owned a property in Ontario for the last 10 years, or over the last 10 years, then guess what? You actually, in my opinion, you won the lottery. And those of you listening, if you've owned a property for 10 years, you know you bought that property for something like 400 grand. And today that property is now worth 1 million, 1.3 million, something in that range. And we'd all love to think it's because we're geniuses, but it's not really that. It is timing. We were in the right place at the right time. and you've become the beneficiary of that. Now, as I go on to say here, you're the beneficiary, but the flip side of that is, your kids and grandkids are the innocent victims on the other side. And they're buying into this market where prices are up, the ability to qualify is also more difficult. And so it's actually just getting exponentially harder than it used to be. And so they're likely going to need your help. And this conversation is also for people with young children who, no doubt, I have younger children myself. The focus for us is education for them, which hopefully gets them a good job, and then gets them a good income. But as you can see, like, the good income is unfortunately not enough in today's GTA, right?
Well, and
And
that's a point you make quite often, and I know in your workshops, a good income is fabulous for you and your loved ones, but it's frankly not enough to purchase a home in the GTA where you and I focus the majority of our business. So I love how you're looking at this. So talk to me like I'm a 10-year-old. Like, what do I need to do here, Dion?
Sure. I mean, okay, so let me just carry on here, because if you're that homeowner, 40, 50, 60 years old, and you understand this, you see the logic behind this. Behind all of that are some concerns, right?
Mm.
And again, what I'm about to put up on the screen here, Gary, are conversations, the stuff that comes out of conversations we have with our clients on a weekly basis. They're like, Dion, I want to help, but there's a couple of things I'm a little bit worried about, right? One of them is, maybe you're worried about robbing from your future self. So if you're going to write a check to your child to help them get into the property market for 100 grand or 200 grand, then it's logical to think that, oh, hang on, am I creating a future problem, right? Where I'm not going to have enough in my retirement to look after myself, right? And then while you're trying to help your kids today, maybe you're going to become a financial burden later on, right? And I totally get that, right? And the good news is that there are ways that you can manage that all, whereby we look at not only just helping your kids, but also helping yourself build wealth through real estate for that better retirement. And maybe we won't go too deep into that today, Gary. We might save that for another conversation. But I want to let all the listeners know that there are solutions around that. By the way, the other way to help your children is not just by giving them cash. Maybe they have enough cash for down payment. The other solution is co-signing, where
Co-signing.
you're making money. You can add your income to your child's application, but of course, we want to make sure they can afford that monthly payment. And just because you can buy for $2 million doesn't mean that you should co-sign and let your child buy a $2 million property.
Yeah, yeah, well said. And a lot of the times we look at this and you want to purchase where you want to live, and I totally get that. And I know you've helped many in the past, and I know I've helped many first-time home buyers in the past. Don't buy where you want to live because you simply can't afford it. The affordability doesn't work. So we look at other alternatives like buying an investment property in an area where the affordability does work, right?
Correct. Yeah. I mean, that was my first move personally. I needed to live downtown where I used to work, and that's going many years ago in Brisbane, Australia. And but I owned a property about 35, 45 minutes outside of town. I still own that property today, actually.
That's
And
amazing.
yeah, it's a property. Geez, I'll tell you the numbers. Actually, I paid 60 grand for that place back in, I think it was 2022, 2023. So yeah, 20 years ago. And I just went back to visit that property over Christmas time. Well, not just to visit the property, but I was in Australia, so I went and visited that property. And today that property is now worth somewhere in the 450 range.
Yeah.
And it was, but going back, that was the thing that gave me confidence to go off and buy other property, right? That very first step.
Yeah. Yeah. So you and I really, we've been property owners for going on 20 years, 20 plus years. And it's not, you could say, hey, we were in the right place at the right time, but also it's the length of time in the properties or in those investments, right?
Correct. I mean, and the best example of that, it's not exactly real estate focused, but is our buddy Uncle Warren Buffett, right? And I was listening to him recently and hearing some commentary, and the fact that we all know him is fantastic. But it's really because he's been investing for nearly 80 years,
Wow.
right? And so if you and I were to just hold on to our properties that we own for the next 80 years, we'd probably be on the front pages as well, maybe. Because if this thing just compounds and compounds like it always does, then it's a path to being millionaires. And that's, I know that you're already there. A lot of your clients you've helped to get there as well. But time, it's the old saying, timing the market versus time in the market. Time in the market always wins.
Yeah, that's right. That's right. So you have a first-time home buyer or someone coming to you, and there's an affordability obstacle that we'll talk about. How are you coaching that client? What's that conversation look like?
Yeah, sure. So, I mean, like I said earlier, we first determine what they can do by themselves. And for simplicity, let's use an example of $100,000 income in today's market, and assuming that they don't have 20% down, okay? Because most first-time home buyers by themselves can't save 100, 200 grand. So they've got a minimal down payment, which is 5% or maybe a touch more, depending on the value of the asset. So at 100 grand, I'm going to be saying to this person, you can probably borrow something in the range of 450. And then if you've got a down payment of say $50,000 saved somehow, then you're buying for $500,000. So that's the first step. Figure out what you can do by yourself. If the outcome of that is a number that is just not manageable, or doesn't work for where you need to be, then that leads to the conversation of, okay, who can we get involved? In most cases, it's a conversation with parents, and then we can go and talk to family members about how they can be involved, deal with their concerns, like I mentioned earlier. What does co-signing mean? What does giving my child this amount of money mean? And I'll also tell you that in some cases, it's not just a gift. It's okay, maybe in the future when you're back on your feet, maybe you'll repay us. Maybe we can benefit from the growth in the child's property as well.
I like it. I like it. And it's important to have those conversations because not many people understand the value of those conversations. It's incredibly important to have them and to connect with people like Dion before you start putting pen to paper because that can go a long way from the affordability piece to how smooth of a transaction something does become, right? And the success of it.
Yeah, yeah. And I'll give you some examples around that. When I raise the question with clients, so would your parents be open to this discussion? Many of them have said, oh, we've never talked about it, right? And so it's now, okay, well, let's start the conversation. And then once their parents get on the phone with us and we break it down, they go, oh, okay, this is not as scary or as deeply involved as we thought. And it makes it much easier. Sometimes the parents say, yep, I'm ready to sign. But the child goes out looking for a property and they end up finding a property where they don't need the parents to sign, just depending on where they end up buying. But it's always nice to have that additional backup in the event that we need to go to that higher price point. Yeah, so they're things to consider.
Yeah. And maybe in a future video, we'll not to get really deep in the weeds, but maybe we'll kind of play on the surface a little bit about what that affordability actually looks like. And what, if an income X, this is what a property purchase price could look like. And if you were to add, say, an income helper, like a basement tenant or secondary suite, what that could do for affordability and qualifying things like that. So these are all things that as home buyers, as investors, as property owners, as Canadians and Americans, if you're watching, or Australians, wherever you are in the world, it's important to educate yourself and to follow people like Dion. Dion, as we wrap up here, how do people get a hold of you?
Yeah, just Google my name. I think there's only one of me, Dion Beg. That's DionBeg. You can reach out to us, and yeah, my website is mortgagesbydion.com.
There you have it, my friends. So thanks again for Dion for jumping on. We'll see him in a couple of weeks from now with more insights into how we get qualified for our investment properties, how we buy properties as homeowners. So for Dion and myself, we'll see everybody in the next video. Bye for now.